Hey guys, so welcome to the Iceland Capital. Welcome to the Iceland Capital, the Iceland Capital Workshop, Forex Workshop 2024. This is the first batch. So we already had the live sessions, yeah. Over 7 days, I brought on some persons, 2 traders actually. I brought on two traders, and we talked about Forex. I showed everybody how to trade successfully. I gave them rules, different things. So I'm here to make a summary. This series will not be about how to trade Forex. So it could be one video, it could be 2 videos, I don't know. I'm going to do it one time, no editing. I'm sitting on my chair right now. This is Saturday. I just came back from the field. I want to do this with my time today. You understand? I want to do this with my time today. So let's go. So what basically Forex is like coined from 2 words, foreign exchange. Foreign exchange. It's just the basic buying and selling of currencies. You understand? Let me give you an example now. Let's say I bought dollars like last month. No, let's say I bought dollars around September or October. When $1 was $1 was equals to 700 naira, right? Let's say I bought $1,000. I used Binance. I bought and I kept. I bought USDT. It's the same thing. So I bought the $1,000 using 700,000 naira. That was my spend. 700,000 naira. 700,000 naira. That's what I bought, right? And I kept it there. I bought $1,000, right? Now the rate of dollars increased to $1 is now equals to, right now is around 1.5. It's around actually 1.6. Let's say 1.6. Let's say 1.6. Sorry. Let's say 1.6. So $1 now is around 1.6, right? My 700,000 naira that I deposited, right? Let's say if I sold the dollars now, let's say it's still $1,000. Oh, it is still $1,000. Let's say I sold the dollars now, I'll be getting nothing less than 1.6 million naira. You understand? I bought dollars at 700,000 naira. I bought $1,000. This is around October, right? When $1 was 700 naira. The same $1 now rose to 1.6 naira. If I convert the same $1,000 to naira, I'll be getting 1.6 million. So this is the beauty of Forex. You're earning in dollars. You understand? This is just foreign exchange. You understand? It's just foreign exchange. Someone that bought dollars and kept is making profit in naira. If you bought naira and kept it, you are making loss in dollars. You understand? Because let's assume I didn't convert that 700,000 naira. Let's say I did convert that 700,000 naira to dollars. How much do you think $700,000, 700,000 naira will be in dollars right now? If you convert it to be around divide 700,000 naira by 1.6. Divide it by 1.6. Let me check the calculator. You will be having 437 US dollars. 437 US dollars. That's what you'll be having instead of $1,000. So this is the beauty of Forex. You know when to buy currencies, you know when to sell currencies, you know when to do things. So that's the beauty of Forex. Let's say you are buying you have US dollars, but you feel that the pound will be stronger. The pound will be stronger. So what do you do? You sell your US dollars and you buy pound and you hold. You understand? Let's say in a month's time or in a week's time, the pound gains strength against the US dollar. You can sell it for more profit. So this is what people do all the time. They buy and sell currencies. So this is Forex. Now in Forex trading, what we do is we buy and sell different currencies at the same time. Under 1 hour, we have bought one currency. Under next hour, we're buying another one. You understand? That is what we do in Forex. That is what we do in Forex. So if you're in Nigeria right now, or just know that you need to start earning in dollars. You need to start earning in dollars. Dollars right now is around 1.6. This is actually an old screenshot. Dollar right now is 1.6 naira, 1,600 naira. So you need to start earning in dollars, right? So Forex can give you this, can give you this kind of freedom, to earn comfortably in any currency in the world. You understand? You can earn in dollars, you can earn in pounds, you can earn in Canadian dollar, you can earn anything. Now, my Forex background, I started trading in 2020, ending towards the end of 2023. Yeah, after I broke my leg, yeah, stuff like that. So I met my partner then at this community service in 2019. I was just messing around with Forex then, just messing around, not really serious. So he told me he was trading with this juice strategy. It was an indicator share. And I was intrigued, and we just started laughing at ourselves. We're just messing around, losing money, make some money, lose money. So we came together and started trading on this strategy, harmonic strategy. And then we created a group together. The group is called Juice Traders. We're trading just purely harmonics. But the harmonics was not that consistent. But now, with my experience, I'm able to trade different strategies, to be honest. I've traded almost everything. I've traded ICT, I've traded SMC, I've traded a lot of things. And now I've settled that, okay, this is what works for me. For me, this is what works. This is what brings food to my table. This is what pays my bills. This is what works for me personally as a person. It gives me money, daily. At the end of the week, I know I am making money. So that's just my Forex background. My first deposit was, I've bought courses too. I bought a lot of courses. My first course, I paid 20,250. The guy just taught me stuff that was on babypips.com. Very easy. I was angry because I wasted my money on knowledge I already knew. So I was thinking that I was going to be getting something different, but I was not. So I had to go to YouTube. Most of my knowledge is from YouTube. I've paid for SMC course before. I've paid for some courses too. I've gotten some certificates. But, most of my knowledge came from actually looking at the charts, spending time, back testing. That chart time, it's non-negotiable. It is non-negotiable. Spending time on the chart, looking at your chart, being in love with the chart, being in love with your computer. I don't know. It makes all the difference. The difference between you and your mentor right now is that your mentor puts in the work. You're not putting in the work. So if you're an experienced trader right now, you need to start looking at the chart. You need to be obsessed with chart time. You need to be obsessed with success, because 90% of Forex traders lose money. That is a fact. If you want to be among the 10% that make money, or the 5% that make money regularly, you need to put in the hard work. You understand? You need to put in the hard work. Yes, they said one, there's this quote I like: hard work pays, but please do the hard work first. So that is just basic about my Forex background. Forex currencies. Now, we trade Forex currencies, but we do not trade them as individual. You cannot just say, oh, I want to buy USD now because USD is no. You buy them, we trade currencies in currency pair. You understand? These are currencies and these are currency pairs. What is a pair? It's just mixing two currencies together. That is a pair. You can speak GBP and JPY now. We'll call that pair GBP, JPY. So this is a currency pair, and this is what we trade. If I want to buy GBP, JPY now, it means that I'm saying, okay, GBP is going to get strong, and JPY is going to get weak. That's all I'm saying. If I like this pair now, USD and Euro, right? So the pair is called Euro USD. We trade in currency pairs, not in currency. We don't trade currencies as singular units. Yes, we trade in currency pairs. USD JPY, GBP JPY, USD and GBP USD, Euro USD, Euro JPY, Euro GBP. You get, so we trade in currency pairs. There are different currencies, like tens and tens of currencies. You understand? So there are different currencies, and we trade in currency pairs. We trade in what? Currency pairs. And if in any given currency, let's say we have, they said the price of GBP USD right now, GBP USD right now, let's say the current price is 1.8253. What does it mean? It just means that the price of 1 GBP, the price of £1 is equal to 1.8253 USD. That is the meaning. So this is the base currency, and this is the quote currency. So the first currency in a currency pair is called the base, and the second currency is called the quote. So in Euro USD now, Euro is the base, USD is the quote. In GBP JPY now, GBP is the base, JPY is the quote. I hope that is clear. Our profit is made. The profit is made by selling and buying. Selling and buying. If I'm selling a market, not if I'm selling Euro USD now. Let's say I'm selling it from here. If I want to make profit on this trade, the market needs to start going down. Same thing applies when I'm buying. If I'm buying from here, if I want to make any profit, the market needs to start going up. So if the market is going down in a buy, this is a buy, right? If the market starts going down, I'm making loss. In a sell, same thing. If the market is going down in a sell, I'm making profit. But if it's going up, let's say the price is increasing, I'm making loss. So this is how trading works. You need to know the right time to sell and to buy so that you can make what? Profit. This is a buy profile. What does this mean? You can see I've marked out this clearly. This line right here is your entry point. This is your stop loss. What does stop loss mean? Stop loss means the point where, okay, we're in a buy, right? We're buying this market. Assuming this market starts going down and it reaches this area, the market would automatically close so that I don't incur more losses. Stop loss means to stop my loss. Stop loss means what? To stop my loss. That's the meaning of stop loss. So the meaning of take profit means what? Take my profit at this level. So once as price is going up, right, and you're okay with profits around this level, you can take your profit. So the market will automatically close your trade in that profit. Same thing goes for stop loss. The market will automatically close your trade in loss to avoid further loss. The same thing in a sell. This is a sell profile. This is our entry point. The market has gone down. This is our take profit, right? So once the market reaches this level, the market closed you in profit, right? If the market has gone up and reached this level, the market will close us in what? In loss. This is stop loss and this is take profit. That is the difference. Now, this is why we use a stop loss. Very important. You can see this spike right down here. If you had not used a stop loss, what would happen? You would have incurred more losses on your account. And in most cases, people blow their account with this spike. So that is why stop loss is very important. Look at this one now. You bought here, right? You bought around this level. The market started going down. This, your stop loss, has prevented you from these possible losses. That is why we use stop loss. So any trade you take, always determine where your stop loss will be. It's very important. Now, the stop loss theory. A properly placed stop loss is truly the starting point of a successful trade. For you to have a long successful career, you need to have what? A stop loss. You need to use stop loss every trade. Forget about making profit. Make sure you are what? Managing your loss potential, because you don't control the market. Make sure you're what? You are putting your stop loss in an area where you are confident. Okay, if price gets to this area, this analysis is wrong. Do not hold trades like this so that you avoid losses like this. Very important. People who don't use stop loss eventually stop trading because of what? They keep blowing their account. The mental part of the game is there. You're always losing. When you're losing very big. You understand? These things, they eventually roll up and become too much for the person, and they stop trading. It's very important for you to use stop loss, guys. Always use a stop loss. That is my first rule for you. Now, how do you make money from trading? You make money from what? Let me tell you something. In trading, there are different things. We have small loss, we have big loss, we have big profits, and we have small profits. If you can avoid taking big loss, if you can if you can just eliminate big loss from your trading, you are on your way to having a successful trading career. If you can avoid big loss in your trading, you're on your way to having a successful good career. Now, the next one is, how do you make money from trading? Make money from what? Do not take your profits early. What do I mean? You enter a buy here, your stop loss is here, right? Your take profit is here. The market now moves small, just small. You start taking profits. Why? Now, this level right here, let's assume now your loss is $10. Your risk is $10. That means if it goes to stop loss, you are losing only $10. And if it goes to take profit, you are winning $30. So if it goes to take profit, you're making $30. If it goes to your stop loss, you are losing $10, right? The market now moves more, like $2 or $3. You're not taking profits. In the long run, you will blow this account because you're not allowing the market to reach your take profit. You are taking profit too early. That's why you see traders. If you check their statements on MT5 or MT4, you see things like $3 profit, $10 loss. And ask yourself, why are your losses bigger than your profit? This is why they eventually stop trading. This is why they are not in the game for long. This is why they cannot manage. They are always blowing their account. Do not be that trader. Do not be that trader. The next one is risk to reward. What does risk to reward means? Risk to reward means how much risk are you taking on this trade, and how much potential reward are you getting? Now, if I'm entering a trade now, let's say my risk I'm entering the trade from here. My stop loss is here. Let's say my stop loss is maximum of $20. So that means my risk on this trade, if it goes to stop loss, is what? $20, right? It is $20. And my take profit is here. My take profit, if it goes to my take profit, right? I will make what? I'm making $60. Guys, out of 10 trades, let's say I win 5. 5 win, 5 losses. 5 wins, that is 5 times 60. This is $300. $300 profit, right? 5 losses, 5 times 20, $100 loss. Minus is 300 minus 100. This is what? $200 gain out of 10 trades. This is a 50% win rate. 50% win rate. But what made us profitable? Risk to reward. Your reward for every trade should be like minimum times 2. For me, it's times 3. If I'm risking $1, I want to be making $3. If I'm risking $20, I want to be making $60. If I'm risking $10, I want to be making $30. If I'm risking $5, I want to be making $15 on that trade. Do you understand? On that trade, on average. So don't take profits too early. Make sure your risk reward is good. Keep your losses small. Big profits, small profits is acceptable, but now what is break even? Break even means, let's say you're in the buy now, market is going, right? It's going up. Your take profit is around here. Your stop loss is around here. Now the market is in profit, right? You can move your stop loss to your entry price. That means if it comes back, or adventure it comes back, what will happen? You'll be kicked out of the trade. You would be kicked out of the trade, but you will not lose any money because your stop loss is now at entry point. No loss, no gain. That is the meaning of break even. So let us keep going. Now look at this. This is what we call risk to reward. Risk to reward. Now this is a bad risk to reward. This is a good risk to reward. This is 1 to 2. So you can see the risk. This is the risk on this trade, and see the reward, very small. See the risk on this trade, the risk. See the reward, big. So you should know from here, good risk reward and bad risk reward. Now this is a 1-to-1 risk to reward, meaning if you are risking $1 and this trade goes to profit, you are making only $1. If you are risking $10 and this trade goes to take profits, you are what? You are making $10. So 1-to-1 risk to reward. I do not advise this though. I do not advise this though, but because you will need to be very, very consistent. Your win rate needs to be very high. If you are using 1-to-1 risk to reward to be profitable. Because if you lose 5 trades, right, and you win 5 trades, that means at the end of the day, no profits, no loss. You understand? So it's not really advisable. Now this is the one I ate. 1 to 0.5 risk to reward. You are risking $1. You are risking $2, right, to make $1. So every time your trade hits stop loss, you are losing like $2. Or let's say you are losing $20. But anytime your trade is hitting take profit, you are making $10. This is a bad risk to reward. It's a very, very bad risk to reward. I do not advise this. I do not advise this. The next one is 1 to 2 risk to reward. This one means for every dollar you risk, For every dollar you risk, right? I can't forgive my drawing, guys. You are making $2 if it goes your way. So if I'm risking $30 on this trade, I should be expecting ×2 if it goes my way. So if I'm risking $30, I should be expecting $60 minimum if it goes my way. Same thing here, 1 to 3 risk reward, it's just ×3. For every dollar I'm risking, expecting $3. I should be expecting $3 on this trade. So if I'm risking $10, I should be expecting to make what? Profit of what? $30. If I'm risking $20, I should be expecting profit of what? $60. Easy to understand. Ah, 1 to 5 risk reward. If I'm risking $1, I should be expecting what? Profit of what? $5. If I'm risking $10, I should be expecting profit of what? $50. So this one is very good, but it might affect your win rate. It might affect your win rate, but it's actually very, very good. So you need to know the ones that work for you. So I recommend 1 to 5. I recommend 1 to 3. I recommend 1 to 2. I do not recommend 1 to 0.5. And I don't know. I don't really recommend 1 to 1. I think your risk reward should start from 1 to 2. Hope you're following me. Why do you need to trade, guys? The economy is getting crazy. This is Nigerian report. If I watch from other country, you might need to skip this. According to the report, 27% of people surveyed earn less than 35,000 naira a month. Guys, 35,000 naira a month in Nigeria right now is around $19, guys. $19, bro. It is crazy. It is crazy. People are earning $19 a month. Why do you need to trade? You need to trade for freedom. Freedom. Like, you don't need to have a 9 to 5 job. All you need to have is what? Follow your risk. Follow your risk. I'll show you ways to earn crazy amounts with Forex. You understand? So these statistics, they're just crazy. I can't even read them because I'll get really emotional because I know how it is in Nigeria. It's crazy in Nigeria. It's crazy in Nigeria. Let's just move on. This is what is possible. This is what is possible. Your risk reward, 1 to 3. If you can follow this plan, you'll be good. 5 trades a week. So your job is to find only one trade. Your job is to find only one trade that can give you, if it's $10, if it's $3, just one trade. I will show you how to find that one trade. If that one trade is not there, do not trade. It's not by force that you must trade every day. I'm telling you that this is maximum. This is what you're allowed per day, maximum, not minimum. You're allowed maximum of 1 trade a day. So it's your job to find that one trade. If you don't find the trade, you don't trade. Maximum of 5 trades a week. Risk to reward ratio 1 to 3. Minimum of 40% win rate. What does this mean? It means after like 10 trades, let's say you had a bad run or something, you had 4 wins and you had 6 losses. 4 wins, 6 losses. 1 to 3 risk to reward. Let's say you're risking these 10 trades. So let's say you're risking $20 per trade. You can do this for $5, you can do this for $10. I don't know. Let's say you're risking $20 per trade. $20 per trade, 4 wins means what? 4 times 8. No, sorry. 4 losses, 6 losses means what? 6 times 20. 6 times 20 is what? 120. So you've lost $120 on losing trades. You've lost $150 on losing trade. Now, for every trade you win, it is 1 to 3 risk to reward. So we are winning $60. You are letting the trade eat TP, and you are winning $60, right? 60 times 4 is what? 240. 240 minus 120 is what? Plus $120 profits. Now, the problem is in that emotional side. People, after, let's say, 2 losses in a row, they start violating the rules. They start doing different things, and they lose the account. But if you are a trader that you are following these rules, you are following everything I'm showing you. If the trade is not there, you don't trade. If the trade is there, you trade. You're following your 1 to 3 risk to reward. You understand? You're following your 1 to 3 risk to reward. You're risking only $20. No matter whether you're in a good run or you're in a bad run, you do not care. You do not increase the risk, and you do not reduce the risk out of fear. You are trading like a sniper. This is what is possible. Even in a bad run, this is a bad run, no? You have lost 6 trades out of 10. This is bad. But at the end of the day, you are what? You are profitable. This is where the game is crazy. This is where you see people at the end of 5 years, like top traders, they are still making profit. Why? Because they understand the concept of what? Risk to reward. They are not rushing, they are following their rules. Because the market is not your father's property. Your job is to manage risk, to protect your capital. Your capital, without capital, you cannot play this game. Without capital, you cannot play this game. So, that is what is possible for you. This is what is possible if you can stick to the rules. I've showed you worst case scenario, that there best case scenario where you are winning 8 trades, 10 trades in a row. So it's very possible. I'm showing you guys worst case scenario. Time to trade in the markets. These are market sessions. This is the one I follow. This is the one I follow. This is all in Nigerian time. Sorry, this is in GMT, not Nigerian time. This is GMT. So the London session starts in GMT, that is London, 7 a.m. to 10 a.m. This is for me. This is the one for my strategy. This is for my strategy. I want to follow it ahead. So the London session will start from 7 a.m. to 10 a.m. for me. New York start from 1 p.m. to 4 p.m. Asia start from 1 a.m. to 4 a.m. These are the times when these markets are really, really strong. Like they move really, really well. Now, for London session, what do I mean? It means when pound, this GBP, right? Let me show you. GBP. You can see GBP is very strong during the London session. Euro, very strong during the London session. You understand? Very strong during the London session. Those pairs, because their bank are opening that period. That is why they call it the London session. So they open during that time, GMT. Now the New York session, around 6 a.m. in USA or so, in New York time, right? 8 a.m. I think is 1 p.m. GMT, if you convert it. So it's the same thing. You understand? It's the same thing. This is when their own bank are opening. So that's when the money is flowing. That is when USD pairs, US dollar, are really, really strong during this period. USD pairs, we have the Canadian dollar. Canadian dollar, they are really strong during this period. Oil markets start moving very, very well. You know, these are when these banks are open. Same thing for Asian countries. Japanese yen, JPY, New Zealand dollar, New Zealand NZD. We have Australian dollar. Their news comes out this period, there are banks open this period. So you need to understand the pairs that are trading, the currency they are trading. When you are trading them, I will not trade cards during London session. I rarely do that. I rarely do that. I would not trade oil in London session. You get, so you need to understand what is going on. You need to understand what is going on. So let's move on. Who are the Forex players? The Forex players, we have the government. This could bring in policies that could affect the flow of money. You understand? If the government says, oh, we're increasing interest rates, you get, what does that mean? It means people will stop borrowing. You understand? We're increasing interest rates, people will stop borrowing. And once they stop borrowing, it affects the flow of currencies, stuff like that. You understand? Yeah. So the policies they bring in, they are different. Commercial bank, these ones they trade currencies, they buy USD, they buy dollar, they buy this, they communicate with other countries. Investment banks, and these are investors. They bring in like big pool of money trying to trade the same market that you and I were trading with our small funds. They control billions of dollars. We have hedge funds, they control billions of dollars. You get, like, I can give an example now. This one that Warren Buffett is managing. These ones that are controlling hundreds of billions of dollars, trillions of dollars. So we have the commercial banks, we have the individual. This is where me and you and I come in, trying to trade our small account, trying to, $5K, $100, $200, depending on the trader. We personally will not move the market because the amount of money these people are bringing in, yourself. Tools needed to make money from trading. If you're new to this space, like you want to know how to trade, you want to become a trader, these are the things you need, to be honest. These are the things you need. You need a smartphone. If you have a smartphone, please try and get a smartphone. Laptop, I think, is very important but personally, it's not really important like that. You can use your phone, but I think it is important. You need internet, though. You need to buy data, you need to buy internet, you need to buy data subscription. You understand? To be able to trade, be able to see live market, and be able to buy and sell. You cannot do that offline. And you need capital. You need capital. You need trading knowledge, and you need a mentor. Now, I'm providing you now with trading knowledge. Mentor and trading knowledge go hand in hand because you need to know how to trade. It's very important. Because forget about bringing in capital. Forget about bringing in capital if you don't have 6 and 7. If you don't have 6 and 7, forget it. You're not gambling. This is not me trying to find a good mentor and learn under the person. Pay them the money, buy their course. I've done these things in the past. All these things led me here. You understand? And the next one is a good broker. I cannot overemphasize the need for a good broker. Good brokers would, they process your withdrawals fast. They process your deposits fast. They give you less spread. They give you less headache. I would recommend you guys a good broker very soon. Now, these are the tools you need to make money from Forex. Now, these are the tools you need on your phone to make money from trading. You need MT5. Go and download this app. Go to your Play Store, go to your Apple Play Store, or your Apple App Store, download MT5, download TradingView, download my Facebook. Now, I'll explain these apps to you now. MT5 is for trading. This is where you place your buy and sell. Buy and sell. TradingView is where you analyze. Let me show you what TradingView is. This is TradingView. Where I analyze, okay, it's time to buy. I place these two, and I go to my MT5, and I press buy and I press sell. My Facebook is where I see the news. It's for news. Because let's say the government want to release a news on, let's say, news on unemployment rate. Let's say the previous unemployment rate for that currency that you want to trade now. Let's say I want to trade USD card or something. Usually that's USD, right? And now we have USD news, USD unemployment, right? Unemployment news in the next 30 minutes. I would wait. How do they move the money? How do they move the, how do the news affect this? Why do you need this? Why do you need this in my Facebook? You need it because you need to know when the news is coming out. Because let's say the unemployment news now, let's say the last month unemployment news was 5.5%. That means they're saying 5.5% of the population are unemployed. And now it now increased. Now they now release the news, it now increased to 10%. This is bad for USD. That means almost all USD pairs should go down. Now, if you are in a buy and you see this figure, or you see that, okay, they're going to release unemployment news in the next 5 minutes, in the next 10 minutes, in the next 30 minutes, you need to close the trade, or at least move your stop loss to break even. Move your stop loss to entry, so that even if it comes back, you will not lose money. So that's why we use my Facebook, to know when news is coming out and to know how to react on our MT4, MT5. MT5 and MT4 are basically the same thing, but I prefer and I recommend MT5. So download MT5, download TradingView, download my Facebook. Let's go. Okay, so how do you work with this Forex thing? How do you work with Forex thing? So if you see this thing now, I'm coming. Like this, if you see this thing right now, you see that there are two prices, right? Yeah, good. So like I told you guys, we have the base currency, this GPUSD. We have the base currency, that's the first one, and the code currency, USD, second one, right? So let's talk about PIP. What is PIP? PIP is the unit measurement for the smallest price movement by Forex assets. See, look at this now. Now, PIP is we start counting PIP from what? The fifth number. The fifth number. So let's start. Is first number, second number, third number, fourth number, fifth number. So if this fifth number now changes, you understand? We'll not have more, you just say, okay, 1 pip, 2 pip, 3 pips, 30 pips, stuff like that. So let's say this 1.3089 changes to 1.3090. This is what they call 1 pip movement. That's changed from 1.3089 to 1.3090. This is 1 pip movement. That is how to calculate pip. So if it goes up 1.3090, that is positive 1 pip movement. And if it goes down, let's say it goes down to 1.3085. Let's say it moves to 1.3085. This is how many pip movements. It's reduced by what? 4 pip movements. It's reduced by 4 pips. So this market has reduced by 4 pips. So you can see in the example right here, it said this one, the 1.3089 has gone to 1.3091. So this is 2 pip movement. You can see 2 pip movement. So let's talk about spread. Let's talk about spread. Spread is basically the difference between the bid and the ask price. This is the bid price, and this is the ask price. I'll tell you why we have these two prices. Now, this is what your broker is offering you. What do I mean? Let's say you want to buy, let's say wholesaler now. Wholesaler is selling a shoe now at $50. And you want to resell, right? You want to resell. You're coming from, let's say, another state or something. You now meet one man that says you can get to the shoe, the same shoe. The man gets you the shoe. The man, let's say the man is middleman. The man gives you that shoe for what? The man gives you the shoe at what? $52. The man has taken nothing concerning the man, whether you make profit from the shoe or not, right? But the man has taken his own $2 gain. Oh, the man has taken his what? His own $2 gain, right? The man has made $2. The man has made $2 gain. If you now go and sell the shoe, if you're not gonna sell the shoe at, let me call this one you. You now sell the shoe at $59. How many profits have you made? You have made what? $7 profit, right? Good. But if you sold the shoe, let's say you don't have any choice, you use your stop loss, stop loss, right? And you sold the shoe at 42, or I'm sorry, 45. You know, let's say $48. You've made loss of what? You've made loss of what? $4. This is basically what bid price and ask price mean. So let's assume that you want to buy JPY. This one right here. You want to buy, they will not give you at this low price. This is the price of the wholesaler, and this is the price of the broker. So you buy at this high price, right? Him has taken his own one pip spread gain. He has pocketed his own profits, 1 pip, right? It does not concern him again whether you make profit or you make loss. That's basically how spread works. So that's the spread on brokers. You can see this one right now. This is a 2 pip spread. So if I want to buy this market now, they'll give me at this price, the higher price, right? And you would need the market to go very high for you to make profit. So that is how broker spread works. So the next one I would look at now, we're going to look at leverage. How understanding leverage will make you money. Now, normally, if you deposit $100 in an account, you cannot use big lot size, you cannot use big stuff. But depositing an amount of money and choosing your leverage, let's say you open an account now, a Forex account, they'll always provide you with leverage, right? Let's say your leverage is 1 to 100. It just means multiply this. $100 is your margin. Your deposit is your margin. $100 times 1 to 100. This is now your purchasing power. Leverage gives you what? Higher purchasing power. That's why you can see people using big lot size and stuff like that. Now, choosing a good broker, you need spread, you need commission. Now, you need a broker that has low spread. Low spread. You can see this one now. This one is giving us 2 pip spread. We don't want that. Low spread, low commission. Commission is fee that you pay for them to open a trade for you. Let's say I want to buy UPUSD right now. They will charge a small fee, very small. So they call them commission. You want this commission to be very low or none at all. You want high leverage. You want them to give you high leverage. So you need to increase your buying power. You want fast withdrawal speed. Fast. You want fast withdrawal speed, and you want your speed of deposit to be fast. So I hope this introduction to Forex was very good. Watch this one to just get a good insight on how Forex trading works. So the next part, we're going to the chart. We're going to be using TradingView. I'll show you how to analyze charts and how to make money. Hope that is good. Hey guys, so this is the part 2 of the free Forex course. The free Forex course, yeah. Einstein Capital Workshop 2024. So I'm basically making this video on a Saturday, right? On a Saturday, and I've not left. What's it called? I've not left where I'm sitting. Like, for real. I just made the part 1. If you go and watch the part 1 first, watch the part 1 first, and then you can come back to watching the part 2. This is part 2. I don't know if there'll be a part. I don't know if there's going to be a part 3, or I will just make everything into this. I think the part 3 will be more the psychology and how to. Yeah, I think that will be the part 3. But for today, we'll be looking at charts. The first thing you want to look at, you want to understand what this is. This is TradingView, right? This is TradingView. This is TradingView interface. You can go to YouTube and search how to operate TradingView. That's not what I'm going to teach you today. I'm going to teach you how to be a trader. So when you come to the chart, you see these different things. See these different things. What do they mean? These are candlestick. These are what? Candlesticks. You can see can change it, can use candlestick, can use line, and cut line. You can use anyone you want, but I recommend candlesticks. You feel me? So I recommend candlesticks. So how do candlesticks form? Why are some short? Why are some long? Why are some, what are these things that are sticking out? I see these lines on the candlestick. What they mean? So for the first and foremost, I want to do a setting. I want to use red and black so that it won't be confusing. So it won't be confusing. All right. So I've set my candlestick to be what? Any candle that is going up should be green. Any candle that's going down should be red. I hope that is fine. So let's start. Let's start with bullish candle and bearish candle. Damn. So we have two types of candle. We have the bullish candle and we have the bearish candle, right? So from here you can see that there are two types of candle. We have the red candle and we have the green candle. So you can see the green candle, right? The green candle is usually the candle that is starting from, that is going up, and this one is going down are red, and the one that's going up, you can see the one that's going up is usually green, the one that's going down is usually red. So the one that's red that's going down is usually the bearish candle, and the one that's going up is usually the bullish candle. Let's just define the candle first. So this is how a candle looks like. This is how a candle looks like, and then we have something coming out of from this side. The same thing is coming out on the other side. So let us label this candle now. Let's call this a bullish candle. Let's say this is a bullish candle now, right? So it means that this candle opened here. This is the open. It opened from here. It went as low as this, and then it went as high as this, and then closed here. I would say that again. This candle opened here, started from here, went as low as this, went as high as this, and then closed here. That is the meaning of this candle. That's how to break up this candle. So it means that it means this is the low, this is the lowest point of the candle. This is the lowest point of the candle. This is the candle's open. This is the candle's close. This is the candle's highest point. So let us label that. Market, the candle opened here. Lowest point, call this low. Closed here, but went as high as this. This is a bullish candle. Why? Because the close of the candle, the close is higher than the open. So this is a bullish candle. So typically, these candles are usually green. Come in. Usually, they're usually green. So this is a green candle, this is a bullish candle. The opposite, the bearish candle. This one is usually red. It depends on the color you use, though. It depends on the color you use. Understand? So the market opens here, right? Closes here. This is the wick. Perfect. So let us label all this. So this is the highest point. This is the lowest point. This is the open. No, this is the open. This is the close. Let us label that. I'll just drag it. Open, low, sorry. So you can see the difference between a bullish candle and a bearish candle. Can you see that? The difference between a bullish candle and a bearish candle. So we can now move on now. We can now move on now. So for this, we'll be looking at the next part of this class. We're looking at support and resistance. So we're looking at support and resistance, right? So what is support? Support is basically All right. Support and resistance, just a basic explanation. Support is basically the floor of the market where buying has taken place before. Resistance is basically the ceiling of the market where selling has taken place before. Let me give you an example right now. So you have basically, let's say the market has come down to this level, but buyers entered the market, right? And market pushed up. The market went up, went down, come down to that level again. Buyers will be alert, be alerted that, you know what, this level again, we might, buy again from this level, and they continue buying. So this area right here is called what? Support. It's called what? Support. Right? And the opposite, let's say the market has been selling from this area. If the market goes back to that level, we could see sellers come into that market again. And you can term that level resistance. You can call that level resistance. Just opposite. You understand? Just the opposite. The same thing over and over again. So, well, let me give an example now of support and resistance, right? Support and resistance. Now look at this level right here. Come in. Now look at this level right here. You can see the market went to this level and bought, right? And sold, right? Now, when it went back to that level, what happened? It sold again. So you can say that this level, right? This level is a support zone. It's a resistance zone, sorry. That's a resistance zone, right? That is a what? A resistance zone. The same thing happens here. You can see what happened. The market has been buying from here, buying. What happens? When the market returned, what happened? We bought again. So if you can identify solid support and resistance zone, you should be able to make money from the forex market. That's just the basic way we play the forex market. Understanding where to buy and where to sell. And we understand that what we are buying in support, and we are selling at what? Resistance. It happens over and over and over again. Do you understand? So the next part of this exercise would be okay. We'll be understanding change in understanding trend. So we have three types of trend, or we have three types of market movements, market phases. Yeah, I'll call it phases. Market phases. That's what I'll use. That is the expression I'll use. So we have the first one, uptrend. Second one, consolidation. Third one, downtrend. You understand? So we have uptrend, consolidation, and downtrend. So these are the three phases in the market that we have. We have the uptrend, we have the consolidation, and we have the downtrend. You understand? So what is uptrend, what is consolidation, and what is downtrend? Uptrend is when the market is just going up, right? It's going up. What does this mean? It means the market is creating higher highs and higher lows. What do I mean by this? This is an high, right? And this is a low. Right? This is a higher low, right? And this is an higher high. How do I know that? This is the previous high. You can see it is higher, right? That market is making higher high. So we're in an uptrend. You can see in this market now, this is a low and it's making higher lows. This market is in a what? Uptrend. Higher lows again, uptrend. Higher lows again, uptrend. So this is a way you can identify uptrend, right? This is a way you can identify uptrend. So you can see the market is making higher highs and it's making higher lows. Also making what? Higher lows. So once the market is in this phase, we have what? Uptrend. So this is a what? This is an uptrend. We also have the second one, consolidation. Let's say the market pushed up a little bit. What happened? The market failed to make significant higher high or lower lows. It's just in a zone, right? It's just in this box. This box is usually called consolidation. This is what? A consolidation. So this is the phase 2. Now in an uptrend, you can have series of consolidation. Not every time it is a sharp movement. You can have series of consolidation. It happens. But you need to understand that it's a phase. We have uptrend, consolidation, downtrend. Now the second one, the third one is, the last one is downtrend. Yeah, we're making what? Lower lows and lower highs. Lower lows and lower highs. Lower lows and lower highs. What do I mean? This is your low. This is your high. Now this high right here, it is lower than this one. So this one is called lower high. So this one is called lower high, right? So this high again, this high again, right? This one is also called lower highs. Lower highs again. So once the market is making this consistent lower highs, we call that what? Downtrend. Lower lows, lower highs, consistent. We call that downtrend. Let me just move this. So you can see the difference between the three phases in the market. We have the uptrend, we have the downtrend, and we have the what? The consolidation. So it's your job to be able to identify these movements in the market. Now let's go on to the chart right now. Now you can see this market is making what? Higher highs, higher lows. And you see that higher highs, higher lows. Consistent. So this means what? We're in a what? Uptrend. And in an uptrend, you need to be looking for buys. You need to be looking for what? Buy. This market is making higher highs, higher lows. As opposed to this, where this market is making lower lows, lower highs, lower lows, lower highs. So this is a downtrend. This is an uptrend. You understand? That's a downtrend and that's an uptrend. And in this phase, we have a consolidation. So you can see the three phases of markets: downtrend, uptrend, consolidation. It all happens. It all happens. You understand? It all happens. Now look at this. This market, I told you guys that we can have consolidation in an uptrend or in a downtrend, right? Now this market was an uptrend, right? Higher high, higher lows, and then it went into this consolidation, very brutal consolidation. All you need to do is what? Be able to identify uptrend, consolidation, uptrend, continuation, downtrend. Look at it again. Uptrend, consolidation, uptrend, consolidation, uptrend, downtrend. After the downtrend, what happened again? We have uptrend, and now we're looking at downtrend. So it is your job as a trader to be able to identify what phase of the market are we in? Are we in an uptrend or are we in a downtrend? So you have to know, okay, I should be looking for buys in an uptrend, and I should be looking for sells in a downtrend. You understand that? Good. So now we've spoken about this. Next thing we need to talk about is we need to talk about the change of trend. Change of trend. How do you identify change of trend? That is a very important question. My first change of trend in an uptrend my first change of trend in an uptrend we have the market is in an uptrend, right? For that trend to change, we need to make markets makes lower low and lower high. If the market can make lower low and lower high, that should be your first signal that you know what, the market is about to change from uptrend. The market is about to change from uptrend to what? Possibly downtrend. The opposite is the case for downtrend. Market makes higher high and higher low. Once you're in a downtrend and the market makes higher high and higher lows, you know that, okay, you know what? The market is what? The market is what? Is changing to a what? To an uptrend. And the market makes lower low and lower high. You know that the market is what? Changing to a what? A downtrend. Now, here's where the support and resistance comes into play. In this uptrend, here, the market, the support, sorry, the resistance the support turns to resistance. And for downtrend to change to uptrend, here the resistance turns to support. I will explain. Now you're in an uptrend, right? Market is making higher high, higher lows, right? Now look at all this. This level right here, all these levels, right? I'm marking out resistance. I'm marking out what? Resistance. So this area right here, this point, this eye right here, this is a resistance, right? Because the market has sold from there. So in an uptrend, resistance is turning to support. Do you get the gist? In an uptrend, this resistance is turning to support. Resistance is turning to support. Resistance is turning to support. But in a change of trend, right? This support right here will not change to what? Will not turn to resistance. Support starts turning to resistance. Do you get the gist now? Now we are let me delete this again, so I'll explain again. We were in an uptrend. In an uptrend, the market's resistance was changing to support, and we're buying from there. You understand? These are resistance that turn to support, right? That turn to support for this market to grow from. So this market now, if the market forms lower low, you can see these are higher lows. Let me put there. Higher lows. These are all higher lows. If the market puts a lower low, this low is lower than this, right? Then that's our first clue that we're thinking to a what? To a downtrend. The second one is where this low, this support, turns to resistance. I hope that is clear. Now, the reverse is the case for downtrend. In a downtrend, the market is creating lower lows and lower highs. And normally in a downtrend, the support is turning to what? Resistance. But if we start to create higher highs and higher lows, that means this downtrend is over. And we're now focusing, we're not changing from downtrend to uptrend. Because of what? We are forming what? Higher lows and higher highs. Let me show you this. This is a lower low. Lower low, lower low, lower low. And instantly we add higher low. Yeah, I think that should be that should do it. I'm coming. Should be the low, not the high. Yeah. So these are all higher lows, lower low, lower high, lower high, lower high. You know, in the downtrend, you are making lower highs, right? But once you now change from making lower highs to making higher high and higher lows, that means you are changing from downtrend. You are changing from downtrend to uptrend. So this is the change of trend we spoke about. This is the change of trend we spoke about. So I want to be buying in an uptrend and I want to be selling in a downtrend. Only if the market keeps creating higher lows and higher highs in that uptrend, or the market keeps creating lower lows and lower highs in that in that downtrend. Yeah, lower rise. You understand? So this is the change of trend we're talking about. And in this downtrend, here the resistance. This is a formal resistance. This is a resistance. This is a resistance. This is a resistance. This is a resistance. This resistance has not been broken and not turned to support so that we can buy from. Remember, I told you that we're buying from support and we are selling at resistance. That is the goal of Forex. I want to buy at support. I want to sell at resistance. So let's go onto the chart right now and see how this has been playing out. Okay. Let's look at change of trend. So this. Okay, I'm coming. So basically, let us look at the market flow from right here. We are making lower lows, lower highs. You can see that lower lows, lower highs, lower lows, lower high, lower lows, lower high, right? And then the market started making what? This lower high, higher low, first low, higher low, higher high, higher low, higher high, higher low, higher high, higher low, right? The market style have changed from lower lows, lower highs to higher high, higher lows. So this is where we have what? Change of trend. And then we add this consolidation. Do not forget. Then we add that consolidation, and then we continued the trend. We continued the trend. Higher highs, higher lows, higher highs, higher lows, higher highs, lower lows, lower high, lower lows, lower high, lower lows, lower high, lower lows. You can see the way the market is changing. It is the same delivery every time. It is the same delivery and now from that lower lows, we now made what? Higher high, higher lows, higher highs, higher lows, higher high, higher lows, higher high, higher lows, higher high, lower low, lower high. Definitely, we should be expecting what? Lower lows. So you can see how the market is changing from what? Lows to highs. This is very, very important. Very, very important. Now you can see the usefulness of what? Of support and resistance. The usefulness of what? Support and resistance. This is what they call the change of trend. The change of trend. I don't know. I think I'll make this. This should be the part 2. And this is where we'll draw the curtains. So the next one, breaking a strategy, how to trade, how to use this knowledge that you just earned to trade. So the part 3, go and watch it. It's on the channel right now. I'm going to make the part 3. I'm going to make the part 4. So I'm sitting right here. You understand? Just do your best to subscribe. So this is I think the part 3. I think this is the part 3. The part 3 of the advanced Forex course. I'm not thinking whether I should just make it into one video. I don't know. I don't know. We'll see. Anyway, anyways, so let's start. Let's get started. This is the strategy part. You've understood how structure works. Higher highs, higher lows, change of trend. You know, you've understood all those parts. You know what a candle is. The first thing you need to understand is timing. You need to understand timing. So the first thing I want you to do is I want you to understand days, how to check the days, right? So this is oil, right? This is oil, right? So let me just delete all of this drawing. So we have a clean chart. You can see I have clear indication of, this is Monday. If you look on the chart, you can see this is Monday, this is Tuesday, this is Wednesday, this is Thursday. How do I know? What are these lines? You just come to your settings right here on your trading view. Go to settings, chart settings, and you go to events, and you can see you have to have the session break on. Without the session break, your chart will be plain like this. So you go to your chart settings, you on the session breaks. That's the first thing you do. The first thing you do, you turn on the session breaks. I'm coming. This coffee just keeps me, very energized. I'll be sitting here since morning now. It's almost 4 p.m. So the first thing you do is that. Now, the second thing you do, you need to have an indicator on. You need to have an indicator on. So what do? You go to your indicator space. So tap on the indicators. Search for market sessions. Market sessions. Dash by Leviathan. Leviathan. Not market sessions and volume profile. Market sessions alone, and you tap on it once, just once. Once you tap on it, you should see that, okay, you some random boxes on your chart, right? You look at your top left and you see the name of the indicator on the chart. Double tap, you can see Tokyo, London, New York. You can rename this Tokyo to Asia. Asian session. Can you remember I told you guys that I give you guys a template from the part 1. So I'm going to use that template right now. So, but now I want to do something for you. I want to do something for me. I'm not going to be using the same input. Previously from that part 1, I told you guys that the market sessions for GMT, this is GMT, right? This is GMT settings. So it's start from 1 p.m., 1 a.m. Asian session start from 1 a.m. to 4. It starts from 1 a.m. to 4, right? Is it 4? Yeah. What I will do is I will put this at 12 a.m. Why 12 a.m.? I want to see the first hour. I want to see the first hour, that first hour manipulation. I want to see the first hour, right? And how it works. The manipulation in that first hour. So put it like that. So 12 a.m. to 3 Asian session, all set, right? Good. London, put it at 6 a.m. 6 a.m. to, let's say, 9. Let's say 9. So I'm working with 3-hour windows every session, 3-hour window in every session, right? New York, put it at 12 p.m. to 4. So 4 is 16 o'clock. Do not check the last one. And this is your settings. Click on OK. And we have our chart. Now you can change the settings of the color. You can come Asian situation, you can put this. You can go to London, you can put blue. You can go to New York, you can put, let's use the color. Depends on your choice. So let's use this for now. Depends on your choice. Now, there are three things you need to understand. Now, I want to work with liquidity. I want to work with three areas when I'm coming to the chart. When I'm coming to the chart, there are three areas I want to look at. First, eye of the day. I want to work with high of the previous day. I want to work with low of the previous day. And I want to work with closing price of the previous day. Right? So now I want to trade only the New York session. I hope you guys are getting this. This is what I'm doing. I'm not telling you to do it. This is not financial advice. I'm showing you what I do and what you can do too. But it's not financial advice. So what I want to do, I want the market. I want to, let me just explain eye of the day and let me explain that first. What is eye of the previous day? Eye of the previous day is just the highest point the market reached, right? So you can see this is the highest point the market reached yesterday, and this is where the market closed yesterday. Before, that's why I told you guys to use these lines, right? So you can know closing price. Low of the previous day, this is the lowest point the market reached, right? And that is the highest point the market reached. So that is the eye of the day. These three things are constant. High of the previous day, low of the previous day, closing price. These are the three things I use when I'm working on the market. Now, what I want to see when I come to the session, I want to see like three pushes. Push one, push two, push three to the high of the previous day. Break of structure, pump, and dump. This is what I want to see. That's part one, what I want to see. Right? Part one of what I want to see. Now, part two. You can take a screenshot. Part two, let's say the market closed here. It closed closer to the high of the previous day, right? What I want to see is this. The market takes out the high, breaks structure, and I know that, okay, the closing price would serve as what? Would serve as what? Resistance, and I will sell. So when the market goes back to closing price, I will sell. The same thing for the buy. Let's say the market closed here. Let's say this is the closing. Let's say this is the closing price. Let's say this is the closing price. The market now does what the next day? The market plays around the next day, breaks the structure, right? We have higher high on the inside.
back to the closing price for the pump. So these are the patterns I want to see. I'll give you the rules very soon. So the most important thing, number one, break of the previous day's high. Without this one, do not look for any entry. I will show you the difference in the trades I took just yesterday on Friday. I will show you that. That will be our examples. I'll show you some examples on US oil. I'll show some examples, and that will be it. So it's your job to go and what? Practice, because this shit happens almost every day. Do not be limited to one pair. Well, this I talk for another part of the video. Right? Number one, I'm trading the New York session. You know when the New York session starts? It starts 1 hour after the. Let me show you what I mean. This is when the New York session started from. But this is what I want to see. This is when the New York session started from, right? 14 o'clock, right? So that first hour is not really the New York session. You can see this is the New York session right here. This manipulation is the New York session, and we bought. So I'll explain to you guys when we get to the chart. But for now, just understand the patterns I'm looking for. Break of the previous daily high or low. Number two, market shifts. I want to see the market shift. It could be what? Creating higher high when it takes the low of the previous day. When the market takes the low of the previous day, I want to see higher high. If the market takes the high of the previous day, I want to see lower lows. If I don't see lower lows, I'm not interested in the sell. I'm not interested in the buy. If I don't see the higher high or the lower low, you guys already know how market trend changes, right? Good. So you understand the change of what? Of what? Market structure. How it changes from lower lows, lower lows, lower lows, and lower high to what? Higher high and higher lows. That is why I taught you guys structure first. This is why I taught you guys structure first. So you add break of previous daily high or low, you add your market shift, right? What's the next thing you need to see? Now, I'm trading in the session. Very important, I'm trading in the session. The third thing I want to see is number three. I want to see 3 candle. Let me type it well. My 3 candle entry pattern. I just call it 3 candle story entry pattern. It's too long. 3 candle. My 3 candle entry pattern. 3 CE pattern. Right? So these are the 3 things I want to see. 1, 2, 3. That is all. That is all. I'm trading in the session. It's very important. Now for some rules. Number 4, always trade after the news. I will show you how to check the news. I will show you that how to check the news. Always trade after major red news. After the major red news, I will show you how to check major red news for that pair. If you are trading in your session, you should be looking at for USD pairs, USD news, and Canadian news. USD news and Canadian news, very important. So you are getting me now, right? Good. So these are the things I'm looking at for. Low of the previous day taken out, market shift, 3 candle entry pattern. What is the 3 candle entry pattern? This is the 3 candle entry pattern. Now, let's say I want to buy now from this market, right? let's say I want to buy from this market now. The market goes to the previous daily low. Let me give you an example now. Takes the low, creates something like this, and then creates higher high. This retracement, this pullback right here, I want to see a specific signature. Do you get? I want to see a specific signature. Market pulls back, and I'll show you why that signature is very powerful. Pulls back, and once you see the signature, you go in. You do what? You go in. So the signature is this. Now for bearish, let me call this let us analyze the 3 candle entry pattern together. For bearish entry and for bullish entry. You know that red candles in this chart are bearish candles, right? They are bearish candles. So we have 3 bearish candles. And then we now have what? Bearish, bullish engulfing. What is a bullish engulfing? Bullish engulfing is a candle that swallows the body of the next candle. You can see this is an engulfing candle, right? This is an engulfing candle because it swallows the body of the next candle or the previous candle. So this is a bullish pattern. So if you see this pattern now, this pattern of candle in this area, if you see it in this area, you go in and you buy. You go in and you do what? And you buy. Where is your stop loss? This is your entry, stop loss, right? Where would you be targeting? Then you know I'm targeting, you can target the previous daily high. You can use range expansion using your Fibonacci. This range right here, take it to the low, and you target the full range expansion. This one right here. This is the use of Fibonacci. Go and watch videos on Fibonacci to understand what Fibonacci means. So I'll explain to you guys later on this one, but I'm explaining to you guys the entry right now. For this, for the bullish pattern, this for the bullish one. Entry, stop loss, right? This is your entry, this is your stop loss. Same thing here. This is my long and short tool. Entry, stop loss. And you can target now. You cannot use the risk reward I told you guys. You can use 1 to 2, right? Or you can use 1 to 3. Check this tool. It is on trading view. It is on what? It is on trading view. You can see it there on trading view. You see long position, short position. It is on trading view. Go to the projection site. You see it on trading view. So you can target 1 to 2 or 1 to 3, anyone you want, anyone that you're comfortable with. So if you're risking like $10 here on this trade, you're expecting nothing less than $30 once the trade reaches its completion. Do you understand? Good. So that's that for the bullish pattern. Same thing for the bullish again. You can also have 2 candles. It could not be 3. 2 bearish candles. Sorry, let me just do the last one. Engulfing. This engulfing could engulf the 2 of them, or it can engulf one of them, or it can engulf 1.5. I don't know. But it must be more than the previous one, right? Good. So you have your bearish, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40, 41, 42, 43, 44, 45, 46, 47, 48, 49, 50, 51, 52, 53, 54, 55, 56, 57, 58, 59, 60, 61, 62, 63, 64, 65, 66, 67, 68, 69, 70, 71, 72, 73, 74, 75, 76, 77, 78, 79, 80, 81, 82, 83, 84, 85, 86, 87, 88, 89, 90, 91, 92, 93, 94, 95, 96, 97, 98, 99, 100, 101, 102, 103, 104, 105, 106, 107, 108, 109, 110, 111, 112, 113, 114, 115, 116, 117, 118, 119, 120, 1 So you have your bearish candles, and then you have one bullish engulfing. It must be an engulfing. I will show you what that means on the chart very soon. I want to be fast with this. All right. So this is for the bullish entry. Bullish entry. Now let us do for the bearish entry. It's just the opposite. It's just the opposite. Nothing fancy there. Push up. Push up. Bearish engulfing. So this could be, yeah, sorry. Just the same thing, just opposite, right? Bullish candle, bearish engulfing. So this one should be 3 candles, right? 3 candles. Yeah. So bullish candle, bearish engulfing. Right? So I think that is good. Yeah, I think this is good. So the same thing. Bullish candle, and we have bearish engulfing. Just opposites for the bearish entry. I'll show you guys how to spot this and what to see before looking for this. So what is your entry? Same thing over here. The same thing over and over again. Shit. Entry, you are selling here. Entry, you're selling here. Entry, you're buying here. Stop loss. Stop loss. Stop loss. So you can see how everything is just interchanged. So this is the 3 candle entry pattern. I'm now ready to enter the chart. I will show you how to look for target positions. Do you understand? So let's go on to the chart right now. Let's start from this. This also applies to low of the week. It was very important. Low of the week, before I forget. It's not only the previous day. It's not only the previous day. Week and day, months is also there. You understand? These are very good levels where the market tends to reverse from and do things. If they give you that, if they print that way, you should know that okay, something is about to happen. You feel me? So yeah. So this is 30 minutes chart. Where can we go? Start from like this now. January 12th. Let me check January 12th. Um, Yeah, 15-minute chart, sorry. Now look at this, now look at this, look at this. Now look at this. So if you come to this market, we're not interested in the Asian session. We are not interested in the London session. Once the market opened, where do you think it went to? It went straight to the high of the previous day. And from there, we didn't get an entry though, but you can see what I'm trying to say. Same thing happened the next day. We went to the high of the previous day. 3 pushes. Asia, London, breaking structure, right? Lower low, lower low, lower low, lower low. 3 candle entry pattern. Bullish 1, bullish 2. The same thing I told you guys. Bearish engulfing. This is a bearish engulfing. After the 3 candle entry pattern, this is your entry. You bring your stop loss to your selling to 40 pip stop loss, right? Where are you targeting? This is now where you now for me, I like to target from selling, I like to target the low of the current day or the low of the previous day. Do you understand? I like to target the low of the current day or the low of the previous day, or closing price. Or closing price. This is where closing price comes into play too. Look at this trade now. Where is closing price? This is closing price right here. So I just know, okay, you know what? Market is usually drawn to those levels. So you just put your targets, closing price. This is 3.5 hour. You can see it there. Risk to reward ratio, 3.5 hour. That means if you are risking $10 on this trade, you should be coming out to what? $35. Right? So very good trade. Easy, no stress. Easy, no stress. Understand? So these are the type of trades you want to be taking. These are the type of trades you want to be taking. Now look at this one again. This all happens. You are trading the New York session, guys. You are trading the New York session. The market, this is just US oil. Oh. I'm not going to different pairs or anything. Just US oil. I'm showing you what is possible. The market goes down, right? Now it goes, market goes to the high of the previous day, right? So it's going there, going there, going there. What happens? We're waiting for what? Break of structure. Very, very important. Very, very important. Break in structure. This is our lower low right here. The market was forming higher high, higher lows, right? Higher high, higher lows, higher high, higher lows. So it's forming all of this, right? Higher high. And then what happens? Lower low. This is what? Change of trend. Change of what? Trend. Very important. I taught you guys this. What happens? The pump and dump. After the formation of the lower low, what do we have? Pump and dump. Now, for this entry, this is a more risky entry because we didn't see the 3 candle entry pattern, right? We didn't see the bullish, 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 then bearish engulfing. But we saw the pin hammer. This is a pin hammer. This I'll talk about this entry in another day, another video rather, because this is a very good entry. But for your skill level, this is a trade you would have missed. But me personally, no. It's around 25 pip stop loss, 30 pip stop loss. Where will be targeting? We'll be targeting the low of the current day. This is a 2.3 hour risk to reward. 2.3 hour risk to reward. You understand? 2.3 hour risk to reward. These are the type of trades you want to be taking. These are the type of trades you want to be taking. Now, if you targeted the full listing, these are around 3 hours. But do not be greedy. Take your 2 hour risk to reward and go. Do not be greedy. Come out the next day, do the same thing. Come out the next day, do the same thing. Repeat, rinse and repeat, rinse and repeat. You understand? Rinse and what? Repeat. Let's take the 30-minute chart for 17th January. 17th January, 30-minute chart. This is 30-minute chart, 17th January, right? Low of the week. This is Monday, Tuesday, Wednesday. Where is the low of the week? This is the lowest point of the week. This area right here. The market goes to the low of the week. Push 1, push 2, push 3. Break of structure. Dump and pump. Now this should be a 5-minute entry. I'm not really sure. But if you're using I like to use the 15-minute chart personally. So if you use the 15 minutes chart, right, you will not have got an entry here per se, right? You wouldn't have got an entry here per se. I'm coming, let me check something. So these are the type of trades you want to be taking, right? So let me just show you another example. Let's keep going from that day. Let's keep going. Now look at this trade, right? This is 30-minute chart, by the way. This is eye of the previous day, right? This is eye of the previous day. Now this break of structure. This is why I like using the first hour. The first hour is very, very tricky. The first hour is very, very tricky. Now, many people have seen this will say, oh, break of structure, time to sell. No. This break happened in the London session gap. This is the low of the current day. So that's why you need to follow every rule. Every rule is very important. Every rule is very important. You get, so let me check 18th January. 15-minute chart, 18th January. Okay. Good. Very good. So you can see now this is 18th January, right? Let me delete it. The market went to the high of the previous day, pushed up, broke structure in the first hour at the low of the current day. This area is a fucking good area for liquidity. What happens instantly? Pump, broke structure, right? Dump and pump. Now, I did not take this. I don't think I took this buy per se. I didn't take the buy. I didn't take the buy because I was waiting for another bearish candle and then another pin. I didn't get this. So I think I traded another pair on this day. Yes, I traded another pair on this day. This is January 18th, yeah, Thursday. So these are the ways you avoid losses too. By playing by the rules. By playing by the rules. Very fucking important. Very fucking important. Let me check the 1 hour chart. 19th January. 1 hour chart. Okay. So now look at this now. Look at this. This is not really a fucking good entry or anything. I'm just pointing it out. Took out the previous daily high during London. Broke structure, lower low. This is a 1 hour chart, by the way. Lower low on the inside. Pump 1, pump 2, bearish candle, right? Dump. Now, this is not a bearish engulfing. So these are type of trades you stay away from. But it still worked out. But this is where I filter my own trades so that I have the best possible return. You understand? So let's check out on Monday. January 22. Monday, January 22. Check out Monday, January 22. Monday, January 22. Okay. So the market has taken this out. The market has taken this out, right? Took out the low of the previous day, right? Broke structure in the first hour. Broke structure in the first hour. Let's take the 15-minute chart. January 22, 15-minute chart. Show you guys how to think like a trader. In cases like this here, this is when you would need extra break of structure. Extra break of structure in that direction. You understand? So let's take the 5-minute chart. All right. So yeah, January 22. I'm coming. This trade, I miss this trade this day. Like this US oil. I don't really trade US oil every day. I think I miss the trade this day. Yeah. Okay, let me explain this trade to you. Start from the 15-minute chart. Sorry. So market went to the low of the day or the previous day. We've had 3 pushes. Very strong. 1 push, 2 push, 3rd push, change of trend, right? Dump and pump. Now, this is tricky because we had the changing trend before the market opened in New York. But as we add this higher high, all you needed to do was traded the return on the 5-minute chart. The higher high right here. All you needed to do was trade the return. So where is the return? Where is the retracement? This is the retracement right here. Bearish candle, pin, bullish engulfing. This is your entry. So this kind of market, you need to use different time frames. This trade will give you easily 3 hours. Where would you be targeting? Be targeting the high of the previous day. The high of the what? Previous day. Very important. Now, let me show you another example. This is the closing price. This serves as more confluence. So as market was dumping into closing price, you're not taking the trade, but you're waiting for more confirmation. So as you got this higher high right here, all you needed to do was wait for the dump and pump. Dump and pump. Very easy. Very easy. So if this trade you have given you 3 hours easily, you are targeting the high of the previous day, and yeah, you understand. So let's go on to the next day. It's like a backtesting session. It's like a backtesting session. I want to show you something, how to use this. Let's look at Tuesday, 30th January. Now, this is why I trade different pairs, because one pair can give you this pattern twice a week. Another one can give you once a week. Another one can give you 3 times a week. Some will give you 0. So you need to have like a basket of instruments. So what I do, I have US oil, I have NASDAQ, I have US 30, I have USD card, I have Euro card, just to give me a lot of options. I'm not pick out one. Just one. All you need is one trade that day. And you're Gucci. Because you need the one that will go to the eye of the day. You know, that will break structure. You need one here. Just one. You could have 3 that went to the eye of the day, right? 3 went to the eye of the day. Only 2 break structure. Only one could give you that 3 candle entry pattern. And then you take only that one. Sometimes it could be 6 that went to the eye of the day. Sometimes it could be 4 that broke structure. And 3 give you the 3 candle entry pattern. You now decide, okay, which one is stronger based on the higher time frame bias. Let's say one was showing it on 5 minutes, one was showing you on the 15-minute time frame, one was showing it on the 30 minutes time frame, right? So you pick the one I was showing it on the 30 minutes time frame because that one is stronger. I hope you get what I'm trying to say. So this is how I filter through trades. You understand? I filter through trades like this. I filter through trades like this. So it works every time. It works every time. So I'm going to January 30, right? January 30, this is 5-minute chart. So we're on January 30 right now. I think we're using the 15-minute chart for this. I think this is the last example I'll show on US or somehow. I'm not really seeing not really seeing much like that. We'll go to NASDAQ. I'll show you guys the trade I took yesterday. So January 30, very good trade, very fucking good trade. I took this trade from here and I bought up and I was done. But it gave us a very good entry. This, if you're following this strategy principle, you can see this is low of the previous day. Market went there, tap it once, tap it again, tap it again. So 3 pushes out of the previous day, right? Broke structure, very important. Broke structure. We've now had higher highs. We've now had higher highs. Now wait for the dump. Bearish candle down, bearish candle down, bearish candle down, bullish engulfing. Sweet entry. Sweet fucking entry, guys. You can get your 1 to 2, you're done. You can target closing price from Friday's closing price. That's where it went to. And that was it. Very good trade, very good trade. Even if you are targeting, like say, you're targeting the high of the previous day, right? And the market started doing something like this, you just close it. That's my advice. You just close it and come out the next day. You don't need to force the market because it was already at the end of the day. These are 9 o'clock, 8 o'clock Nigerian time. You don't need to force it again. You get what I'm trying to say. So you don't need to force the trade. So once the trade is not really pushing up again, just close it. It's not making higher highs, it's making, can make lower lows, like just close it. But this is a fucking good trade. This is a fucking good trade. Let me see if we can see one more. This is another one right here. Let's see. This will be the last one I take. I show. This will be the last one I beg. This will be the last one. I will show another one on US 30 and NASDAQ just yesterday. So went to the low of the previous day. 3 pushes again. 3 pushes. 1 push. 2 push. Higher high. You understand? Higher high. 3rd push. Broke structure. Dump and pump. So let's use the 30-minute chart first for this. Or let's use the 30-minute chart first for this. Yeah, coming. So this is 5-minute chart. What day is this? This is Monday, right? So this trade was news day. Very important. This was a news day trade. You wait after the news. The news was around 15:30 Nigerian time. So this is 15:30, right? This was when the news started here. So you don't trade on the news, you trade after the news. So the news went to make the 3rd push outside the previous daily low. And what do we have? We had break of structure. But our first break of structure was right here. I want to show you something very, very serious. I'm showing you. So let me go to the 30-minute chart. Yeah, so this is 30-minute chart, right? So you can see the market doing what? The market was making lower lows, lower high, lower lows, lower high, lower lows, break in structure. This was our first break in structure. What happened? The market went to the low in 3 pushes. Bearish candle, bullish engulfing. This is your entry. Where are you targeting? You can target the high of the day. You can target the high of the day. This is around 35 pips. Yeah. You can target the high of the day. This area right here for 2.9 hour, almost 3 hours. Very easy trade. Do not stress. You understand? Very easy trade. Do not stress. Because on the 5-minute chart again, what was happening? We broke structure on the 5-minute chart. So you can be using these 2 charts interchangeably, right? On the 5-minute chart, you are seeing break of structure. On the 30-minute chart, you're seeing bullish engulfing after the 3 candle entry pattern is confirmed. You've had higher highs on the 30-minute chart. You have higher highs on the 5-minute chart right here. Higher highs right here. So the market has shown that it wants to go high. With the 5-minute structure, the 30-minute candle play, 1 candle, 2 candle, 3 candle to the low of the previous day. Very fucking important, guys. Very fucking important. You understand? So these are the very easy trades you need to look at. Now, let me show you something on the NASDAQ. I'm very tired of US oil. I'm tired of US oil, guys. For real, tired of US oil. So now for NASDAQ, let's look at NASDAQ. Let's restart the chart view. So I took a sell on NASDAQ. On Friday. So a very beautiful trade. The market went to the high of the previous day. Let me delete all of this. Okay. Deleted. I took this trade on a 15-minute chart. Let's analyze it together. Let's put on the indicator. Indicator is not here. Ha ha ha. Indicator is not here. So let's put that on. All right, let me just set it up. The indicator is not here. Sorry. 002. I think this was 3 o'clock. This was 9 o'clock. This was 6. This was 12 to 4. So 16. And we're okay. So I want to trade in the New York session. First hour New York session. On the news, I've told you guys we want to trade after the news, right? After the news. So the news broke structure. We've gone to the high of the previous day. The news broke structure. Bullish candle up. Bullish candle up. Bullish candle up. Bearish engulfing. This should be your entry. How many pips stop loss? 15 to 7. Let's also call it 20 pips stop loss. Let's say use a 20 pip stop loss on this trade. This trade instantly. Where would you be targeting? Low of the previous day. There's a reason why this trade is a low of the previous day trade. You can see the trade 7 hour. Look at it, 7.3 hour. NASDAQ. NASDAQ gives the most when the trade is moving. NASDAQ gives a lot of hour, a lot of reward. Yeah, NASDAQ US30, they give a lot of reward. Very fucking good trade. Look at that. Very fucking good trade. Clean trade. Now look at US30. US30, when the market was falling down on NASDAQ heavily, US30 was not doing anything. Why? Because US30 has not gone to the high of the previous day yet. So guess what happened when the market went to the high of the previous day? As it went to the high of the previous day, it didn't waste time. Bam. It dropped how many pips? It dropped 230 pips. Sorry, 250 pips instantly. You need to understand the power that resides in the market taking these levels. High of the day, low of the day. And now look at this again. I'm showing you something. When the market went to the low of the previous day, right? This is the 5-minute chart. The market went to the low of the previous day. I took a buy. This is the low of the previous day. The market went there. What happened? We broke structure. 3 candles down. Bearish candle, bullish engulfing. You enter. Give yourself some room to put your stop loss here. I don't know. You enter around here. 1, 2 hour trade and you're out. I took this trade yesterday on Friday. You understand? Very good trades. Now, what do I use for my own entry? Personally, I use the 15 minutes candle entry. Why? I'll tell you why. 1 candle down, 1 candle bearish, bullish engulfing. So I put my entry here. My stop loss was around, yeah, this entry, this level right here. and I got around one to, because when the market side misbehaving, I just closed. You feel me? I just closed. My normal target was here, the high of this level. That's what I was targeting, but I closed around here. You understand? I closed around there. So you need to understand that you need to understand the power that lies around these levels. Low of the day, and where? High of the day. I hope this strategy would help you guys. The main thing is do not be stuck on one pair. Do not be stuck on one pair. It is very important. Do not be stuck on one pair. If you're stuck on one pair, then I don't know. Because you need to wait a lot if you're stuck on one pair. I trade every day and I trade only one pair. Yesterday I traded Nasdaq alone. And I traded no, this is not the only strategy I traded, but for this strategy, I trade only Nasdaq yesterday. And for this strategy, I trade only the previous day I traded, I think US, no, not US, trade I think US 30. I'm not mistaken. No, I'm not sure. I trade different strategy, but this one appears like almost every day. You understand? Almost every day. Check gold, appears there, it works there, it works like sham. You get, look at this one now. Low of the previous day. Market push, one push, two push, third push. In this third push, right? There's an entry right here that could give you a good scalp back to the high of the day. Very important. Yes, I think I traded. I didn't trade gold yesterday because it didn't go to the high of the previous day. So, yeah. So, you guys need to understand what is going on. What's going on. Those levels are very important. Even if you don't trade this system, you need to understand that those levels are very important for what? You use those levels for, number one, entry, exit, liquidity. You need to use those levels to understand entries, exits, and liquidity. So I hope this session has been very impactful. I'll try to upload the workshop on here. I'll try to do that sometime next week. Before now, I want to rest, like for real. For real, I want to just rest. So I think that's all for now. And the next part of this course will be next part of this thing will be to talk about managing your trades, how to calculate lot size, stuff like that. So yeah, that would be it. How many trades you take in a week, all those kind of things, psychology stuff. Yeah, that's what I will do. So for now, this is just strategy talk. This is just strategy talk, straight to the point. So the next part will be about mental sharpness, risk management, psychology, prop firm, and we're done. That's it, guys. So make sure you like this video, you subscribe, you share. Very important. If you have trader friends that want to learn how to trade Forex, direct them to this playlist. Let's start from the beginning to the end. And I'm very sure that, and they should watch the workshop. I think I don't know where I shed more knowledge on the workshop. I'm not sure, but I think the workshop definitely. That's all for now. Hey guys, so this is the last part of this course. Is part 4. I'm still thinking whether I should just record everything. No, whether I should just like jam everything and make it to one video, or just upload one by one. I think uploading, like editing everything into one video would make more sense. I don't know. When I sleep and wake up, I'll know what to do. So anyways, let us dive into it. Today, we are looking at basically we're looking at basically the last part of the video. You guys already know what to do. You know charting, you know time frame, you know what Forex is about. You know you have to make money, guys. You know you have to make money. Let me break out how to make money from Forex, how I make money from Forex, and different things. You know, this is the most important part, I think. No, the most important part is the knowing how to trade. Now you know how to trade. What you need to do now is chart time, back testing. I back test every day. I don't back test every weekend. I back test every day. I'm not back testing. I'm making video. I'm making these kind of videos. I'm teaching myself too. You know, I'm helping myself too. You cannot just sit down on the weekend, come on Monday and start trading. You're not going to make any money, guys. Like for real. You need to work on yourself every fucking day. Put in the work. Learn new things. Go on YouTube. Pay from some mentor. I don't know. Get into mentorship. Get into different things. Watch videos. There's different things you can do to better your life. And Forex can give you so much more. Let's dive into it right now. I don't want to waste time. I want this video to be like 20 minutes max and we're done, 10 minutes max and we're done. So the first thing you need to know is how to calculate what is a lot size. What is lot size? How do you take trades? You can see like lot size. What does lot size mean? Lot size is basically your buying power, like your trade power. I call it trade power. If you use someone that used one lot on a trade, that you guys took this trade, right? And you made 20 pips profit. Let's say you bought EURUSD at one price, and two of you, the same trade, you closed at 20 pips. This guy used one lot, you used 0.01. Same 20 pips, right? This person that used one lot, his own money profit will be bigger than you. It's not cost. Not see feel I'm costing you. It's making how much now? 20 pips. Is making around $200. And you are making $2 profit. Same thing when you guys lose. You are losing maximum of $2. Him is losing maximum of what? $200. So the bigger the lot size, the bigger your risk and potential gain you get. So let me now explain to you guys how the lot size works. So let me start here now. The minimum lot size, minimum, is 0.01. This means for every pip movement, we have $0.1 profit or loss. So if your trade goes into 1 pip profit, your profit should be showing $0.1. If it goes down 1 pip by 1 pip, your loss will be showing $0.1. So if you buy and it goes up 1 pip, you are making $0.1. If you're in a sell and it goes down 1 pip, you're making $0.1. You make profit in sales when it's going down, and you make profit in buy when it's going up, right? Very good. So this is now straightened out. So how do you now know the lot size to use for your trade? So if you're not using, let's say if you're not using example now. Example, you use $0.1 on a 0.1 lot on a trade. This means for every pip, you are either losing or making $1. You just times 10, right? Just times 10. 0.01 times 10 is what? 0.1. The same thing for one lot. For every pip, you are either making or losing $10. So that's why 10 for every pip, you're either losing or making $10. So that means if your profit goes to 20 pips, you should be making $200. That's why I wrote it there. So you just multiply 20 times 10. And for this one, if you multiply 0.1 times 20, it's $2. So the bigger your lot size, the bigger your potential profit and your potential loss. And the smaller your loss size, the smaller your potential profits and potential loss. So how do you know the right one to use? Let us now do an experiment. Let's assume now you have a $200 account. Experiment now. Experiment now. You have a $200 account. Account size is $200. You want to start risking $10 per trade. You are risking 5% of this account. You are risking 5% of this account per trade. That's a $10 risk per trade. And you are taking 5 trades per week, 1 trade per day, right? Account size $200, $10 risk per trade, 5 trades per week, 1 trade per day. This is your plan. Your risk to reward, let's keep it at 1 to 3. 1 to 3 risk to reward, right? On average. So because some trades be 1 to 2, some be 1 to 4, some be 1 to 5, some be 1 to. So let's now say account size $200, $10 risk per trade, 5 trades per week, 1 trade per day, 1 to 3 risk to reward. You take 5 trades per week. You lose 3 trades. You win 2 trades. What is your profit or what is your loss? For every trade, for every losing trade, $10 loss. For every winning trade, it's 1 to 3, right? So 10 times 3. $30. For every losing trade, $10. For every winning trade, $30. Right? You lose 3 trades, 3 losing trades. So losing trades, three times 10 equals to $30. Winning trades, is now what? 30 times 2, $60. Now, if you follow the rules I said to you, you cannot out of 5 trades, you cannot lose 3. Not possible. It rarely happens. But I'm showing you worst case scenario. Most of the times you have 4 winning trades and like 1 loss. 1 loss, maybe you did nonsense or something. But based on beginner level, number 1, beginner level and you're not really familiar with the concepts, this can still make you money from next week. This can still make you money from next week. Now, if you do the subtraction, profits $60 minus $30. At the end of 5 trades, you should have profit of what? $30. Your account size is what? $200. Sorry, your account size is $200, right? Good. At the end of the week, you made $30 profit. This is around 15% profit. No problem. Do not be swayed by Instagram reels. Do not be swayed by all these people that are telling you that they flip $20 to 1K. They flip $20 to 30,000. Just continue making withdrawals. And you get to a point where you are not making $30 again. You are not making what? 300, 300, stuff like that. So now this is the first part you need to conquer. So once you have this, they are making withdrawals every week, right? You are now making withdrawals every week, right? You now go to the prop firm route. You go to the prop firm route. You buy a prop firm account. This is how to be a profitable trader. Prop firm route. Prop firms are basically companies that give you capital to trade, but you have to pay a small amount of money. Let me give you an example now. Let's say you want to trade a $5,000 account with a prop firm. You would have to pay around $45. So now if you have made profit from this scene right now, let's say you have $200 and you are a bad trader, you're not making $30 weekly. You cannot remove $45 from there and buy a $5,000 account. Now they're going to give you live profits, live accounts immediately. You'll be required to do what? To pass phase 1 and 2. Now phase 1 is usually you'll be required to pass phase 1, you'll be required to be able to make around 8% profit. Right? Phase 2, you'll be required to do what? To make, that is your job, to make 5% profit. And once you do this, you'll not be getting funded. So once you are funded now, you now target monthly, right? Monthly, just 2% profit. Monthly, you target 2% profit. This will now add what? Extra $100 every month to your account, right? Just stay with me. Oh. I know it's not much, but you have to stay with me. Stay with me. With these 2% profits, $100 weekly, and you're still making your money from here. You cannot take this $100, save it, right? You keep it until you're not able to do what? To purchase a $50,000 account where you would be required to do to pay, I think $300. No, $250. You'll be required to pay $250 for this account. So you have already made money from your phase 1 and phase 2. And in this profit route, they always return this money you pay, this $40. They return it plus your what? Plus your profit you made. And they give you only, the payment is usually 80% of what you make. Right? So you're targeting 2% profit You're collecting 80% of that plus your initial deposit that you made to them. They're refunding you back. So it should be collected around 150, thereabout. But if you're not making a consistent monthly profit of 2%, you should be able to now get what? $50,000. You pay 250, right? You repeat the same thing. Phase one, phase two, funded, you're targeting 2% profit. How much is 2% profit now? No, previously it was $100. Now it is now what? $1,000. And they're refunding you back this 250 for your first withdrawal. So this is how you grow as a trader. Trader will never see $10 before. As seeing what? $100 now. Now it has not seen $1,000. Now I can use this payout to buy what? A bigger account. Because that mostly their max trading capital is $300,000. You can buy the $300,000 account, buy $200,000, but it should take time. True. Because I don't want you guys to rush the phase one. I don't want to rush the phase two. Now, but there are some loopholes, of course. Nobody's going to make this very easy. There are rules, simple. Do not lose 5% in the day. Do not lose 10% of the account. Simple rules. Just don't do this. Now, this is why I present to you now your own rule. If you cannot follow this rule, right, where I say 1 trade per day, for someone that is trading 1 trade per day, you are trading 1 trade per day, 5 trades per week. You should not be nearing these levels. You should not be nearing the 5% a day because you are risking only 1%. 1%. And once you get funded, you are risking 0.5%. So that only devil or village people, or once, I don't know, something happen, will make you to lose the account. You want your rules to be so tight that it's impossible for you to lose the account. You get? Your target is 2% profit a month. You risk 0.5% on the funded account, and you risk 1% on the challenge account, on the phase one and the phase two. So that once you get funded, you start risking 0.5%. And your target is to make 2% profit. Once you make 2% profit, close your MT5 to not be greedy because you know we are going to. $1,000 is big money for real. When you get $100,000 allocation, you're making extra $2,000 per month. Then you can scale up to per week, stuff like that. But for now, this is the pattern you need to follow. This is the pattern you need to follow. This is how to trade. This is how to become a funded trader, a good, profitable trader. I've been here for, I don't know, 11 o'clock or something. I don't know. So I'll go and edit the videos and everything. Throw me a like, throw me a subscribe to my stuff. But I have a free Signal group. Check the description of this video. And peace out. If you have any questions, you can send them in the comment section. Can send it to my Twitter DM or my Telegram DM. My Telegram is be in the description. My Twitter will be in the description. My free Signal group on Telegram will be in the description. Do not fail to reach out. Peace. And this brings to the conclusion of this series. I think I'm going to make it into one video. If I don't succeed in making it to one video, then I'll be able to. Then you see it in parts. But my first intention now will be to make it to one video. If I think in one video, just know I succeeded. I'll try to edit it, anyhow. Peace.